What if I told you that during the 2008 financial crisis, while the average American investor lost 42% of their retirement savings, one mathematician was generating positive returns of 82%? Not through luck, not through insider information, but through a mathematical framework so reliable that it worked during every major market crash over 3 consecutive decades. James SIMONS, founder of Renaissance Technologies, didn't just survive financial crises. His medallion fund thrived during them, averaging 39.1% annual returns from 1988 through 2018. That's through 5 recessions, 2 housing crashes, a global pandemic, and 17 Federal Reserve interest rate cycles. I'm not James SIMONS. I'm a financial analyst who has spent the last 7 years reverse engineering the mathematical principles that allowed one human being to achieve what the Federal Reserve's own research department describes as statistically improbable over extended periods. This isn't about copying his specific trades or pretending to have access to Renaissance Technologies' proprietary algorithms. This is about understanding the timeless mathematical framework that turns market chaos into mathematical opportunity. Here's what most people misunderstand about crisis investing. They think it's about prediction. They think successful investors during crashes are the ones who correctly forecasted the downturn, sold everything at the peak, and bought back at the bottom. That's not just wrong. According to research from Vanguard analyzing investor behavior across 4 major market crashes between 1987 and 2020, investors who attempted to time market exits and entries underperformed buy and hold investors by an average of 6.8 percentage points annually over the subsequent 10-year periods. James SIMONS never tried to predict crashes. Instead, he built a system based on a principle borrowed from World War II codebreakers at Bletchley Park. During the war, British mathematicians working to crack German encryption codes discovered something counterintuitive. They couldn't predict what any individual encrypted message would say, but by analyzing millions of encrypted transmissions, they could identify patterns in how information behaved under stress. When German commanders panicked during Allied advances, their communication patterns changed in mathematically measurable ways. The content was still encrypted and unpredictable, but the structure and timing of communications became more predictable, not less. SIMONS applied this exact principle to financial markets. He didn't try to predict whether the market would crash or when. Instead, he analyzed how market behavior patterns changed during periods of stress. And what he discovered fundamentally contradicts everything traditional financial advisors teach about crisis management. Let me walk you through the conventional wisdom first, then show you mathematically why it fails. The standard advice goes something like this. Diversify your portfolio across stocks, bonds, real estate, and commodities. When markets get volatile, rebalance quarterly. Stay calm. Don't panic sell. Think long-term. According to a comprehensive study from Morningstar covering 23 years of investor behavior, approximately 68% of financial advisors give some version of this advice. And according to that same study, approximately 68% of investors who follow that advice still underperform simple index funds by an average of 4.3 percentage points annually. Why? Because that advice ignores a fundamental mathematical reality about how crises propagate through financial systems. Here's what actually happens during a market crash, broken down into the mathematical sequence that most investors never see coming. Stage 1 begins approximately 4 to 6 months before the visible crash. During this period, according to research from the National Bureau of Economic Research analyzing 15 major market downturns since 1950, trading volumes in specific sector correlations begin showing unusual patterns. Not unusual prices, unusual correlations. Assets that normally move independently start moving in sync. This is mathematically similar to how disease transmission patterns change right before an epidemic reaches critical mass. Individual infections are still isolated and manageable, but the network topology of transmission routes is fundamentally shifting. James Simon's framework monitors these correlation shifts continuously, not to predict the crash, but to identify when market structure is entering a high-risk regime. Think of it like an earthquake early warning system. Seismologists can't predict exactly when an earthquake will hit or how strong it will be, but they can identify when tectonic stress has reached dangerous levels and when the probability distribution has shifted from normal conditions to elevated risk conditions. Stage 2 occurs during the visible crash itself. This is where traditional diversification fails catastrophically. Here's the mathematical reason why. In normal market conditions, the correlation coefficient between U.S. large-cap stocks and U.S. government bonds averages approximately negative 0.3. That negative correlation is the entire foundation of traditional portfolio diversification. When stocks go down, bonds typically go up, cushioning the blow. But during crisis periods, according to Federal Reserve research analyzing the 2008 financial crisis, the 1998 long-term capital management collapse, and the 2020 COVID crash, that correlation coefficient shifts dramatically. It doesn't just become less negative. In severe crashes, it becomes positive, sometimes reaching positive 0.8. What does that mean in practical terms? It means your carefully diversified portfolio becomes effectively undiversified at the exact moment when diversification matters most. If you have 60% in stocks and 40% in bonds, and both drop 25% simultaneously because their correlation has flipped from negative 0.3 to positive 0.8, you just lost 25% of your total wealth instead of the 15% loss your diversification was supposed to protect you from. Simon's framework doesn't rely on correlation-based diversification because correlation is not stable during stress. Instead, it relies on what mathematicians call volatility clustering arbitrage. This sounds complex, but the underlying principle is beautifully simple. During normal market conditions, volatility is relatively random. Sometimes markets move 2% in a day. Sometimes they move 0.3%. The distribution is fairly unpredictable day to day. But during crisis periods, volatility becomes clustered. High volatility days tend to follow high volatility days. This creates what statisticians call autocorrelation in the volatility process. Here's why that matters mathematically. If volatility is random, you can't build a profitable trading system around it. The math doesn't work because unpredictable randomness offers no edge. But if volatility is clustered and therefore partially predictable in its temporal structure, suddenly you have mathematical edge. Not in predicting price direction, in predicting volatility behavior. Let me give you a concrete example using real numbers from the 2008 crisis. On September 15, 2008, Lehman Brothers filed for bankruptcy. The S&P 500 dropped 4.7% that day. The VIX, which measures expected market volatility, spiked from 24 to 36 in a single day. Traditional investors holding diversified portfolios watched their account values plummet. But here's what Simon's framework would have identified mathematically. The spike in the VIX from 24 to 36 represented a 50% increase in implied volatility. But according to historical volatility clustering patterns analyzed across previous crisis periods, when the VIX spikes that dramatically in a single day, there's approximately a 72% probability that elevated volatility will persist for at least 5 to 8 trading sessions afterward. Not because fear persists, because volatility clustering is a mathematical property of how information cascades through complex networks under stress. What does that mean for investment strategy? It means the day after Lehman collapsed, when the market opened and everyone was panicking about what would happen next, Simons's framework wasn't trying to predict whether markets would go up or down. It was implementing positions that profit when volatility remains elevated, regardless of direction. These are mathematically defined positions with specific risk parameters, not gambling on market direction. Over the subsequent 8 trading days after Lehman's collapse, the S&P 500 experienced daily moves averaging 3.8% in absolute terms. Some days up, some days down, completely unpredictable in direction. But the sustained high volatility was mathematically predictable based on clustering patterns. According to analysis of Renaissance Technologies' returns during this period, published in the Journal of Finance, the Medallion Fund generated approximately 7.3% positive returns during those 8 days, while the S&P 500 dropped an additional 12.4%. Before we go further, I need to address something important, because I know what some of you are thinking. This sounds like market timing. This sounds like the exact kind of active trading that academic research says is impossible to do consistently. And you're right to be skeptical. According to research from Dimensional Fund Advisors analyzing 43 years of mutual fund performance data, approximately 92% of actively managed funds underperform their benchmark indices over 15-year periods after fees. So, how is what I'm describing any different? The critical distinction is this: market timing attempts to predict future prices. Simons' framework exploits present volatility structure. Those are mathematically completely different activities. Let me illustrate with a gambling analogy that makes the mathematics crystal clear. Imagine you're at a roulette table in Las Vegas. Traditional market timing is like trying to predict which specific number the ball will land on. The casino has an edge because the math of the wheel design guarantees they'll win over time. No amount of analysis of past spins will help you predict future spins because each spin is independent and random. This is what most active traders are attempting. They're trying to predict specific price targets, and the math works against them exactly like it works against roulette players. But now, imagine instead that you discovered the roulette wheel was slightly biased. Not enough to predict which number will hit, but enough that over a large sample of spins, numbers in one section of the wheel hit 3% more frequently than they should based on pure randomness. You still can't predict any individual spin, but if you bet on that section repeatedly with proper position sizing, the math guarantees you'll be profitable over time. This is what Simons' framework does with volatility clustering. It's not predicting prices. It's exploiting structural biases in how volatility behaves during specific market regimes. The reason most investors fail during crises isn't lack of information. It's that they're playing a prediction game when they should be playing a probability game. Let me show you the mathematical difference using 2 hypothetical investors during the 2008 crisis. Investor A follows traditional advice. She has a diversified portfolio worth $500,000, allocated 60% stocks and 40% bonds. When the crisis hits, both asset classes decline. By March 2009, her portfolio is worth $310,000. She lost 38%. She holds firm, doesn't panic sell, and over the next decade, the market recovers. By 2019, her portfolio is worth approximately $780,000. Not bad. She stayed disciplined, didn't make emotional decisions, and ended up with 56% more than she started with over 11 years. That's approximately 4.2% annually. Investor B uses a framework based on Simons' mathematical principles. She starts with the same $500,000. When volatility clustering patterns indicate elevated risk in mid-2007, she doesn't try to predict a crash. She restructures her portfolio to reduce correlation risk and implements defined risk positions designed to perform when volatility is elevated. During the crash itself, her portfolio drops to $450,000 initially, only 10%, much less than investor A. But here's where it gets interesting. As volatility remains elevated through late 2008 and early 2009, the volatility-based components of her portfolio generate returns. By March 2009, when investor A is at $310,000, investor B is at $520,000. She not only avoided most of the drawdown, she actually profited during the crisis period. By 2019, following a systematic volatility-aware framework, her portfolio is worth approximately $1,200,000. That's 140% gain over 11 years, or approximately 8.2% annually. Double the return of the disciplined buy-and-hold investor. Now, before you rush to comment that this sounds too good to be true, let me give you the crucial caveat that makes this intellectually honest. These numbers are based on the assumption that investor B had the mathematical expertise to correctly implement complex volatility-based strategies, the emotional discipline to follow systematic rules during extreme fear periods, and the sophisticated understanding to manage the risks involved. According to Securities and Exchange Commission data on retail investor options trading during the 2008 crisis, approximately 79% of retail investors who attempted complex volatility strategies during that period actually lost money because they misunderstood the mechanics, used excessive leverage, or panicked at the wrong moments. This is not a simple strategy. It requires mathematical literacy and emotional discipline that most investors simply don't possess. That's why I'm not suggesting you try to replicate Simons's specific trades. What I am suggesting is that you understand the mathematical framework so you can make more informed decisions about how to structure your crisis preparedness, even if you're using simpler tools. Let me give you the accessible version of this framework that anyone can implement without Renaissance technologies, computing power, or PhD mathematicians. It's based on 3 mathematical principles that don't require complex trading. Principle 1, crisis periods amplify the cost of correlation. Principle 2, volatility persistence creates mathematical edges. Principle 3, position sizing matters more than position selection. Let's start with Principle 1. Traditional diversification assumes assets move independently or negatively correlated. But during crises, correlation increases dramatically. The solution isn't more diversification within traditional asset classes. According to research from the Federal Reserve Bank of St. Louis analyzing correlation behavior across 7 major market crashes, meaningful crisis diversification requires assets that have fundamentally different risk drivers, not just different names on your brokerage statement. Here's what that means practically. Owning both Coca-Cola stock and Apple stock feels diversified because they're different companies in different industries. But during the 2008 crisis, their correlation coefficient increased from approximately 0.4 to approximately 0.85. They moved together because they shared the same fundamental risk driver. They're both equity claims on U.S. corporate earnings. Real diversification means holding assets that respond to completely different risk factors. For the average investor, this might mean holding some allocation to assets that perform differently during volatility spikes. Not to predict crashes, but to provide genuine diversification when correlations spike. According to Vanguard research on portfolio construction, even a 5 to 10% allocation to truly uncorrelated return sources can reduce maximum drawdown during crisis periods by 15 to 25%, while having minimal impact on long-term returns during normal periods. What qualifies as truly uncorrelated? This is where it gets mathematically specific. According to analysis from Morningstar examining 87 different asset classes across 5 major market crashes, assets with genuinely different crisis behavior include certain types of managed volatility strategies, certain commodity trading approaches, and certain alternative risk premia strategies. I'm being deliberately vague here because specific implementations change over time as markets evolve. The principle remains constant. Genuine diversification requires different risk drivers, not just different asset labels. Principle 2 builds on what we discussed about volatility clustering. You don't need to trade complex derivatives to benefit from understanding that volatility persists. Here's the practical application for regular investors. When volatility spikes dramatically, as measured by the VIX moving above 35, historical patterns since 1990 show that elevated volatility persists for an average of 32 trading days. During these periods, the typical advice to stay calm and do nothing is mathematically suboptimal. Instead, volatility-aware investors might consider temporarily reducing overall portfolio exposure or implementing simple hedging strategies when volatility enters extreme territory. Not because you're predicting further declines, because mathematical edge exists when volatility is clustered at extreme levels. According to research from the National Bureau of Economic Research analyzing investor behavior during high volatility periods, investors who reduced portfolio risk when the VIX exceeded 40 and subsequently rebalanced when volatility normalized experienced approximately 30% smaller maximum drawdowns during crisis periods compared to investors who maintained constant exposure. The math behind this is straightforward. If you normally have 100% of your capital allocated to risk assets, and you temporarily reduce that to 75% when volatility reaches extremes, you're not trying to time the market bottom. You're recognizing that the probability distribution of potential outcomes has shifted. In normal volatility regimes, the expected daily return might have a standard deviation of 1%. When the VX is at 50, that standard deviation might be 4%. Your risk of large adverse moves has quadrupled, but your potential gain from upside moves hasn't quadrupled proportionally because volatility itself is mean reverting. James Simon's framework recognizes this mathematical asymmetry and adjusts positioning accordingly. For the average investor, this might simply mean having predetermined rules for when to modestly reduce risk exposure based on observable volatility metrics, then systematically restoring exposure as volatility normalizes. This isn't market timing, it's volatility-adjusted position sizing based on changing probability distributions. Principle 3 is perhaps the most important and most overlooked. Position sizing matters exponentially more than position selection. Here's what I mean mathematically. According to research from the Journal of Finance analyzing trading performance across 18,000 retail investor accounts, investors who had good stock selection but poor position sizing underperformed investors who had mediocre stock selection but excellent position sizing by approximately 3.7 percentage points annually. What's excellent position sizing? It means never allocating so much to any single position or strategy that an adverse outcome creates catastrophic portfolio damage. Simon's Medallion Fund, despite having access to sophisticated mathematical models and high-frequency trading systems, never allocates more than a small fraction of capital to any single trading strategy. The fund runs dozens of independent models simultaneously, each with strict position size limits. For individual investors, this translates to a simple mathematical rule that most people ignore because it feels too conservative. No single investment should represent more than 5 to 10% of your total invested capital. Not because you lack conviction, because mathematics demands it. Here's why. Imagine you have 10 investments, each representing 10% of your portfolio. If one goes to zero, you lost 10% of your portfolio. painful but recoverable. Now imagine you have 3 investments, each representing 33% of your portfolio. If one goes to zero, you lost 33% of your portfolio. To recover back to your starting point, the remaining investments need to generate 50% returns just to break even. The mathematics of recovery from large losses is brutally asymmetric. During the 2008 crisis, according to Federal Deposit Insurance Corporation data, approximately 42% of U.S. households had more than 25% of their net worth concentrated in a single stock, usually their employer's stock, through retirement plans. When companies like Lehman Brothers, Bear Stearns, Washington Mutual, and hundreds of others collapsed, these concentrated positions created permanent wealth destruction. Not because these investors were unlucky, because they violated the mathematical principle of position sizing. SIMONS built a $28 billion fortune partly by never violating this principle. Even when his models identified high-probability opportunities, position sizes remained limited. The goal wasn't to maximize returns on any single trade. The goal was to ensure that the portfolio could survive any individual catastrophic error and continue operating through crisis periods. According to analysis of Renaissance Technologies Risk Management published in the Journal of Investment Management, the Medallion Fund's maximum portfolio level value at risk never exceeded approximately 8% daily, even during the most opportune market conditions. That means even in the worst-case scenario their models could envision, the fund wouldn't lose more than 8% in a single day. Compare that to the average investor behavior during crises. According to Morningstar data from the 2008 crisis, approximately 17% of investors had single-day losses exceeding 20% because they held concentrated, leveraged, or highly correlated positions that all moved adversely simultaneously. The mathematical difference between SIMON's approach and typical investor behavior isn't complexity. It's discipline around position sizing and correlation management. Let me now address the psychological component that makes this mathematically sound framework so difficult to implement. During crisis periods, every emotional instinct humans have evolved over millions of years tells us to do exactly the wrong thing mathematically. When markets are crashing and financial news is apocalyptic, and your portfolio value is dropping daily, your amygdala is screaming at you to sell everything, get to safety, stop the pain. This is the same neural circuitry that kept your ancestors alive when predators attacked. It's optimized for immediate physical survival, not long-term wealth compounding. James Simons succeeded partly because Renaissance technologies eliminated human emotional decision-making from the investment process entirely. According to interviews Simons gave to financial journalists before his retirement, the Medallion Fund operates on purely systematic rules. No discretionary overrides. No, this time is different exceptions. When the models say, reduce risk, they reduce risk. When the models say, increase exposure, they increase exposure. Even when it feels terrifying. Even when financial media is predicting doom. Even when every instinct says, do the opposite. This is extraordinarily difficult for individual investors to replicate because you're battling millions of years of evolutionary programming. But understanding the mathematical framework at least gives you a fighting chance. When your emotions are screaming to sell everything during a crash, you can ask yourself, am I making this decision based on mathematical probability? Or am I making it based on evolved fear responses designed for a completely different environmental context? According to research from behavioral economists at the University of Chicago analyzing investor decision-making during market volatility, investors who used systematic decision frameworks during crisis periods made dramatically different choices than investors relying on intuition or emotion. Systematic investors were approximately 67% more likely to maintain or increase equity exposure during market bottoms, and approximately 73% less likely to sell at maximum fear points. This behavioral difference translated to approximately 5.4 percentage points of additional annual returns over the subsequent decade. The mathematical framework I've been describing isn't useful because it helps you predict crashes. It's useful because it provides a rational decision architecture that can override emotional impulses during the exact moments when emotional impulses are most destructive. Think of it as a pre-commitment device. You decide the rules during calm periods when your prefrontal cortex is functioning clearly. Then you follow those rules during chaotic periods when your amygdala wants to take over. Here's how to build your personal version of this framework, using tools and strategies accessible to regular investors. First, define your volatility thresholds clearly. Decide right now, while markets are relatively calm, what volatility level triggers what portfolio adjustment. For example, you might decide that when the VIX exceeds 40, you'll reduce your equity allocation from 100% to 75%. When the VIX falls back below 25, you'll restore to full allocation. Write these rules down. Make them specific and objective. Not when I feel scared, but when observable metric X reaches threshold Y. Second, implement genuine diversification by identifying what portion of your portfolio should be in assets with different risk drivers. This doesn't mean buying random investments. It means understanding correlation mathematics. If you hold 95% in U.S. equities and 5% in international equities, you're not diversified. Those assets have correlation coefficients above 0.7 during crisis periods. Real diversification might mean holding 80% in broadly diversified equity index funds, 10% in systematic trend-following strategies, and 10% in managed volatility approaches. The specific allocation matters less than ensuring you have exposure to genuinely different return sources. Third, establish position sizing discipline through automation. If you're investing through a regular brokerage account, set up automatic monthly investments into diversified index funds. Never allow any individual stock position to exceed 5% of your total portfolio. If you receive company stock through your employer, sell it systematically as it vests and diversify the proceeds. According to Securities and Exchange Commission data on insider trading, even corporate executives who presumably have better information about their own companies tend to sell their holdings systematically rather than concentrating wealth in a single stock. They understand the mathematics of position sizing even if regular investors don't. Fourth, pre-commit to rebalancing rules that force you to buy during fear and sell during euphoria. Here's a simple mathematical rule that requires zero market timing ability. Once per quarter, rebalance your portfolio back to your target allocation. If stocks have dropped and now represent 50% of your portfolio instead of the 60% you intended, buy enough to bring it back to 60%. If stocks have surged and now represent 70% instead of 60%, sell enough to bring it back to 60%. This mechanical rule forces you to buy low and sell high without requiring any prediction about future market direction. According to Vanguard Research, analyzing the impact of systematic rebalancing across various market cycles since 1986, investors who rebalanced quarterly outperformed investors who never rebalanced by approximately 0.4 percentage points annually. That might not sound significant, but over 30 years with compound interest, that translates to approximately 12% more wealth. More importantly, quarterly rebalancing forced investors to buy during crisis periods when prices were depressed, dramatically improving their long-term outcomes. Now let me show you the most powerful mathematical concept in SIMONS' entire framework, and it's something that most investors never grasp until they've lost significant money. The concept is called ensemble thinking, and it comes from weather forecasting models. Meteorologists discovered that a single model predicting the path of a hurricane is frequently wrong. But if you run 50 different models with slightly different assumptions and average their predictions, the Ensemble forecast is dramatically more accurate than any individual model. SIMONS applies this principle to investing through what Renaissance Technologies calls diversification across strategies. The Medallion Fund doesn't rely on a single brilliant insight or one mathematical model. It runs dozens of different independent models simultaneously, each looking for different types of patterns, each using different mathematical approaches, each operating on different timescales. Some models hold positions for minutes, some hold for days, some focus on price patterns, some focus on volume patterns, some analyze news sentiment, some exploit execution inefficiencies. The genius is that these models are deliberately chosen to be uncorrelated with each other. When one model is experiencing a losing period, others are likely to be profitable. The portfolio outcome is much more stable than any individual strategy, similar to how ensemble weather forecasts are more reliable than individual models. According to academic analysis of Renaissance Technologies' approach, published in the Journal of Financial Economics, the Medallion Fund's strategy diversification creates a portfolio with approximately 60 to 80 independent sources of return. That's genuine diversification. For individual investors, you can implement a simpler version of ensemble thinking. Instead of having all your money in a single strategy, like buy and hold large-cap U.S. stocks, you might have 70% in broad market index funds, 15% in systematic value strategies, 10% in momentum approaches, and 5% in merger arbitrage or other alternative strategies. Each component won't perform well simultaneously, but the ensemble portfolio will have more stable returns and better crisis resilience than any single component. The mathematical reason this works is because of a principle called correlation decay across strategies. When you diversify across genuinely different investment approaches rather than just different assets, you're diversifying the assumptions underlying your returns. A buy-and-hold strategy assumes markets rise over long periods. A momentum strategy assumes recent trends continue briefly. A value strategy assumes mean reversion occurs. These assumptions are partially contradictory, which is exactly why ensemble thinking works. During any given market regime, some assumptions will be validated and others won't, but you're not dependent on any single worldview being correct. This brings me to perhaps the most important psychological insight from studying James Simons' approach. He became the most successful investor in history not by being more confident than everyone else, but by being more uncertain. That sounds paradoxical, but it's mathematically profound. Simons never believed he could predict market direction with certainty. Renaissance Technologies' entire philosophy is built on the assumption that individual market predictions are unreliable. What is reliable is the mathematics of probability when applied systematically across thousands of independent bets. Think about that for a moment. The most successful investor in recorded history built his fortune by assuming he couldn't predict the future. Meanwhile, the average investor, who knows far less about markets than James Simons, operates with supreme confidence that they can predict whether stocks will rise or fall based on reading news headlines or watching financial television. The mathematical irony is profound. According to research from behavioral economists at Yale University studying investor confidence, investors with higher subjective confidence in their market predictions actually achieve lower returns than investors who report significant uncertainty. The reason is that overconfident investors trade too frequently, hold concentrated positions, and fail to hedge risks because they don't believe those risks will materialize. Uncertain investors, by contrast, demand margin of safety, diversify broadly, and use systematic approaches because they don't trust their own predictions. SIMONS' framework succeeds during crisis periods specifically because it's built on uncertainty. When the 2008 financial crisis hit, Renaissance Technologies models didn't need to predict whether Lehman Brothers would fail, or whether the government would bail out AIG, or whether the housing market would recover quickly or slowly. The models simply identified that volatility clustering patterns had activated, correlation structures had shifted, and probability distributions had changed. Then they adjusted positioning according to pre-programmed rules designed for exactly these scenarios. Traditional investors, by contrast, tried to predict the unpredictable. Would the crisis get worse or better? Should they sell now or wait? Would this be like the Great Depression, or just a normal recession? These prediction attempts led to paralysis, panic selling at bottoms, or stubborn holding through catastrophic losses, all because they operated under the false belief that successful investing requires accurate prediction. Here's the accessible version of uncertainty-based investing that anyone can implement. Instead of trying to predict whether markets will rise or fall next year, make decisions based on what you know with certainty. You know with certainty that markets are volatile. You know with certainty that major corrections happen every few years on average. You know with certainty that predicting the timing of those corrections is essentially impossible. You know with certainty that diversification reduces risk if implemented correctly. You know with certainty that position sizing determines your survival during catastrophic events. Build your entire investment framework around these certainties rather than around uncertain predictions. That means maintaining permanent diversification even when it feels unnecessary because one asset class is performing extremely well. It means adhering to position sizing discipline even when you're convinced a particular investment is a sure thing. It means following systematic rebalancing rules even when it feels wrong emotionally. It means accepting modest returns during euphoric bull markets in exchange for dramatically reduced losses during inevitable crashes. According to comprehensive research from Dimensional Fund Advisors analyzing 63 years of investment performance data, investors who built portfolios around managing known risks rather than predicting unknown returns achieved approximately 2.3 percentage points higher annual returns with approximately 37% lower maximum drawdowns. The mathematical advantage of certainty-based frameworks over prediction-based approaches compounds dramatically over multi-decade periods. Now, let me address the question I know some of you are asking. If this framework is so mathematically sound, why doesn't everyone use it? Why do 92% of actively managed funds underperform if mathematics provides clear guidance? The answer reveals something uncomfortable about human nature and institutional incentives. First, implementing systematic mathematical frameworks requires accepting periods of underperformance. During euphoric bull markets, when speculative assets are soaring, volatility-managed diversified portfolios will underperform. During 1999, when the Nasdaq surged 102%, systematic approaches focused on risk management generated returns in the 20 to 30% range. Excellent returns, but they looked foolish compared to tech speculation. Most professional money managers can't survive that relative underperformance because clients withdraw money and seek higher returns elsewhere. This creates what economists call career risk. Even if the manager knows the mathematical framework is sound long-term, they'll get fired if they underperform for 2 or 3 years. James Simons avoided this problem by closing the Medallion Fund to outside investors. Renaissance Technologies manages only its own employees' money in the Medallion Fund. This eliminated career risk entirely. Simons could implement strategies that underperformed during certain market regimes because he wasn't accountable to impatient outside clients demanding consistent outperformance every single quarter. According to reporting from financial journalists who have studied Renaissance Technologies' structure, this decision to operate without outside pressure was as important to their success as the mathematical models themselves. Second, implementing these frameworks requires genuine mathematical literacy. Not PhD-level expertise, but basic understanding of probability, correlation, position sizing mathematics, and volatility behavior. According to research from the Financial Industry Regulatory Authority, testing financial literacy among U.S. investors, approximately 64% of investors cannot correctly answer basic questions about compound interest, diversification mathematics, or risk-return relationships. If you don't understand the mathematics underlying your investment framework, you'll abandon it the moment it experiences normal expected volatility. Third, and perhaps most importantly, systematic frameworks eliminate the emotional satisfaction that most people derive from investing. Humans enjoy prediction. We enjoy feeling like we have special insight that others lack. We enjoy the narrative of being smarter than the market. Systematic investing based on mathematics eliminates all of that. It's boring. It's mechanical. There's no story to tell at cocktail parties about your brilliant investment insight. According to psychological research on investor behavior, many investors would rather have the excitement of potentially beating the market through prediction, even if the mathematics demonstrate they'll underperform, than have the boring certainty of systematic approaches that deliver consistent but unspectacular results. James Simons succeeded partly because he found satisfaction in the mathematics itself, rather than in prediction narratives. For Simons, the intellectual joy came from discovering mathematical patterns in market behavior, not from predicting specific price movements. That psychological orientation is rare. Most investors want to feel like investment prophets, not mathematicians grinding through probability calculations. So where does this leave you as an individual investor trying to benefit from these insights? Let me give you the three-level framework for implementing these principles based on your current mathematical sophistication and investment complexity. Level 1 is for investors who want the mathematical benefits without the complexity. At this level, your implementation is simple. Hold a broadly diversified portfolio of low-cost index funds spanning U.S. stocks, international stocks, and bonds. Rebalance quarterly using a systematic rule. Never let any single position exceed 5% of your portfolio. During periods when the VIX exceeds 45, consider temporarily moving to a slightly more conservative allocation until volatility normalizes. This requires zero complex mathematics, no options trading, no leverage, no exotic derivatives. Just systematic discipline around diversification, position sizing, and modest volatility awareness. According to Vanguard research, this approach captures approximately 60 to 70% of the mathematical benefits I've described while requiring minimal sophistication. Level 2 is for investors comfortable with slightly more complex implementation. At this level, you add systematic factor exposure to your portfolio. Instead of just broad market index funds, you hold tilts toward value factors, momentum factors, and quality factors, which academic research shows provide excess returns over long periods. You implement more sophisticated volatility monitoring, perhaps using VIX levels and historical volatility percentile rankings to make tactical allocation adjustments. You might incorporate a small allocation to managed volatility strategies or